Welcome to our Introduction to Cost Segregation and the Impacts of Tax Reform webinar. We like to begin all of our webinars with an introduction to our company. KBKG is headquartered in Pasadena, California, with additional offices in Illinois, Georgia, New York, and Texas. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineering and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RSME and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax-related issues, including 1031 exchanges, AMT, passive activities, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. Now I'll turn it over to our speaker, Eddie Price, for the presentation.
Before I dive into the topic, let me just share a little about my background. I'm a graduate of Texas A&M with an undergraduate degree in environmental design and a graduate degree in construction management. And I joined KBKG over 7 years ago now to lead our Texas-based operations. I also do quality control reviews on cost segregation studies and fixed asset studies that we do not only in Texas but in other offices around the country. And I'm proud to say that KBKG is very involved in the American Society of Cost Segregation Professionals. This is the recognized professional organization in our industry. And at KBKG, we currently have 7 certified members of the ASCSP, including myself. I currently serve on its testing committee, and I've been a past chair of the education committee. All of the cost segregation reports that I review at KBKG are signed and certified with my ASCSP stamp, which is a symbol of quality to anyone else who might have reason to look at that report and review it. In particular, if an IRS engineer were to look at it, they would understand what that stamp and certification meant. I have over 38 years of experience in the cost segregation industry, and 20 of those were with the Big Four CPA firm. For our learning objectives today, by the time you finish this webinar, you should be able to do the following. You should be able to explain what cost segregation is and how you can take advantage of it. You should be able to identify tax issues that need to be taken into account in conjunction with cost segregation studies and discuss the potential impact of cost seg on estate planning. You should be able to discuss the impact of recent tax reform on cost seg and discuss cost segregation opportunities in relation to the tangible property regulations. There's some overlap there. So with that, let's dive in. First of all, let's look at what kind of properties potentially qualify for having a cost segregation study done. On the left side of this screen, you can see we've listed acquired property, new construction, remodel property, build-outs. All of this is relevant to potentially a cost segregation study. Cost segregation accelerates the depreciation of an asset. It doesn't increase or decrease the amount that is to be depreciated over time, but a good indicator of the potential for a cost seg study is the amount of remaining basis that's left in the property and how many years there are left to depreciate that property. If you've held this property for a really long time and there's not much basis left, there's not much we can do with it. But a cost segregation study should do a few things for you. It should identify all the short-life property that's eligible for accelerated depreciation, and it should also componentize all the real property. Because of the tangible property regulations that were implemented in 2014, cost segregation studies can be leveraged in a way to provide more detail than ever before. And this webinar is designed to provide a real high-level look at cost segregation, but I'd encourage you, if you haven't dug into the tangible property regs recently, consider checking out our website for other webinars, including that one on the tangible property regs. So you can see that we, in the right-hand side of the screen, in a cost seg study, we're typically separating the 39-year real property or the 27.5-year real property in a residential rental setting to the 15-year land improvements and the 7- and 5-year tangible personal property. Well, let's look at an example of how this might work for an acquisition of a $5 million office building. Without a cost segregation study, the basis would be simply depreciated straight line over 39 years, and that's a long time. I mean, depreciating a building, a $5 million building straight line over 39 years is still a benefit. You're still recovering the cost of that building through depreciation. It's just you're recovering it over a very long period of time. So with a cost segregation study, the basis can be segregated into 5, 7, 15, and 39-year recovery periods, resulting in an additional $1.2 million of deductions in the first year and an overall projected net present value benefit if you hold that property over the full 39 years, an overall net present value benefit of $330,000. So it might look a little funny to think about the $330,000 if you hold the property being so much less than the deductions in the first year, but it's because the 5, 7, and 15-year property, and under the current tax law at least, all falls into 100% bonus depreciation. So really you're taking it from 39 years straight line over a long period of time to 1 year of recovery for those assets that we identified in those shorter recovery periods. Here we can see visually how a cost seg study would impact the building. You've got that big spike in the first year where compared to that red line at the bottom, which is the straight line over 39 years. Basically, in this example, $1.25 million depreciated in the first year, which is 5, 7, and 15-year assets due to that bonus depreciation gives you that strong spike. So in this slide, as you can see, virtually all types of commercial and residential rental property are potential candidates for a cost segregation study. What we have in this slide is a very, very general table that describes what a cost segregation study might yield on average for different types of facilities. A big difference maker is always going to be the amount of land improvements, which can certainly vary tremendously based on topography and also local zoning requirements. Depending on what type of facility it is, what type of functions are being performed in it, and how extensive those land improvements are, the building could be at the lower end or at the higher end of this reclassification spectrum. Keep in mind that we didn't break this detail down into individual recovery periods, meaning 5, 7, and 15-year property. So these ranges of depreciation percentages, like the apartment buildings at 20 to 35%, that 20 to 35% sweeps in all of the 5, 7, and 15-year property into those into that one bracket. Section 1245, tangible personal property, is any new or used tangible personal property that has been or could have been subject to depreciation or amortization. Regulation section 48-1C defines tangible personal property as any property except land, buildings and structural components of buildings, and land improvements such as swimming pools, paved parking areas, and so on. Tangible personal property includes all property other than structural components which is contained in or attached to a building. So this would include property like production machinery, printing presses, transportation and office equipment, refrigerators, grocery counters, testing equipment, display racks and shelves, neon and other signs, all of which are contained in or attached to a building. The picture on your screen represents a typical retail store, like probably most of the people on the call have shopped in. And based on my observation of this picture, the items listed on the left are potential Section 1245 tangible personal property that could be depreciated over a 5-year recovery period. Now, in an industrial building where some type of manufacturing is going on, It's common to see dedicated supply water and wastewater systems supporting the manufacturing process. It's also common to see fume exhaust systems. The manufacturing equipment also usually has dedicated electrical switchgear and distribution systems. There might be an emergency generator, an HVAC system that supports special temperature and humidity requirements, and structural framing to support bridge cranes. All of these items I've listed here are examples of tangible personal property in that industrial building. We would consider these assets to be an accessory to the taxpayer's line of business. These assets differ from those that are essential to the operation or maintenance of the building. These phrases are general concepts that have been discussed repeatedly in court cases over the years. That accessory to the taxpayer's line of business started with a case called Morrison Cafeterias. And the operation or maintenance of the building is just always referred to when talking about what a structural component is. So during a cost segregation study, we rely on our expertise in applying these concepts that have been pounded out over the years through court cases to determine which assets can be depreciated as tangible personal property. When referring to land improvements, most tax professionals are thinking of asset class 00.3 from Revenue Procedure 8756, which defines land improvements as any improvements directly to or added to land, whether such improvements are Section 1245 property or Section 1250 property, provided such improvements are depreciable. The asset class goes on to give examples of land improvements like sidewalks, canals, sewers, wharves, fences, landscaping, and so on. For most taxpayers, the identification of land improvements is very beneficial because they have a 15-year recovery period and they're eligible for bonus depreciation. We'll talk more about bonus depreciation eligibility later in the presentation, but the picture here on the right shows you a typical walkaway in an office park. And as you can see, there are many land improvements that would be identified there, some of which are in our list. Cost segregation should be one of the most common tax planning tools for taxpayers that invest in real estate. The study can be done in the year of the assets placed in service, or you could wait till a later year, allowing the taxpayer to take advantage of those extra deductions when they're most useful. If it's done in a later year, there's no need to go back and file amended returns. Instead, the taxpayer files a Form 3115 to catch up on missed deductions from prior years in the current year. A good rule of thumb for when it makes sense to consider a study is when the depreciable building basis, excluding the land, exceeds $750,000. However, for residential rental properties with depreciable basis between $150,000 and $500,000, we do have a software tool we've developed online that can efficiently address those properties too. And that slide, or I guess right here in this slide, I have a link that is a direct link to that tool. We'll mention it again at the end of the presentation. Let's look at some tax considerations. So when you're thinking about a cost segregation study, it's important to remember the following. Those depreciation deductions will reduce your alternative minimum tax. Bonus depreciation can apply to reclassified items in a cost segregation study for new construction projects and as a result of the CARES Act to acquired property as well. Any unused deductions can be carried forward to the future tax years. And when a building is sold, the taxpayer or seller must recapture depreciation taken on the tangible personal property. Accounting method changes are addressed with IRS Form 3115, which means you can retroactively address buildings from prior tax years. Passive activity rules can offset the benefit of a cost seg study, and certain 1031 exchange rules need to be considered as well. When a building is sold, the taxpayer or seller has to recapture depreciation that was previously taken on tangible personal property. Section 1245 recapture is calculated at ordinary tax rates. So that leads us to recommend holding the property for at least 5 years when you're considering a cost segregation study, especially considering that you really don't have to do it in the year you place it in service. As I mentioned earlier, you can always retroactively take advantage of it if you end up holding the property longer than you thought you were going to. When a property is sold, the fair market value of Section 1245 property can be uncertain. The seller can minimize recapture by allocating more of that sale price to the real property instead of the personal property. In many situations, personal property in a building might have little or no value. For example, carpeting that was installed a decade ago likely has minimal worth, especially if the new owner has plans to replace it. In that case, it would be appropriate to allocate only a very nominal amount, if any at all, of the building sale price to that carpeting. A proper valuation of the personal property at the time of sale can yield a lower overall recapture tax. The Tax Cuts and Jobs Act created a new limitation on business interest expense, which applies to all businesses, regardless of their form, on the deductibility of net business interest expense that exceeds 30% of a taxpayer's adjusted taxable income. The good news is that the Act also provides an exemption from the limitation on interest deductibility for taxpayers other than tax shelters whose average annual gross receipts don't exceed $25 million for the 3 preceding taxable years. I know for lots of the clients we work with, that sweeps many of those into that exemption. Taxpayers that are considered to be in a real property trade or business have the opportunity to elect out of the limitation on interest expense deductions. However, the electing taxpayer in that case is required to use the alternative depreciation system for depreciable real property. The ADS recovery period is 40 years for commercial buildings and 30 years for residential rental property. Technically, qualified improvement property was 39 years under the Tax Cuts and Jobs Act, and so would go to 40 years under ADS. However, the recent CARES Act corrected the qualified improvement recovery period to 15 years under the general depreciation system and 20 years under ADS. The result of the mandatory requirement to use ADS is that bonus depreciation is not available to a taxpayer, so no bonus for QIP under the ADS. However, the ADS requirement only applies to the taxpayer's real property. So to the extent the taxpayer has personal property, they can still continue to use the GDS recovery periods for the personal property and get the bonus treatment for that personal property. The bonus depreciation rate was increased to 100% for eligible property placed in service after September 27th of 2017. The new rate is applicable through 2022, and then it's scheduled to begin to reduce by 20% each year after that. The bonus rates can be extended an additional year for long production period property and for non-commercial aircraft. To qualify as long production period property, an asset has to have a recovery period of at least 10 years and be subject to 263 Cap A of the Internal Revenue Code. It also has to have an estimated production period exceeding 1 year and a production cost exceeding $1 million. And it must have also been subject to a written binding contract that was entered into prior to January 1st of 2028. A couple of items to note here about the bonus depreciation. When there is a step up in basis due to a Section 754 election, the step up can receive bonus treatment just as long as the new partner didn't have a prior depreciable interest in that property. If the taxpayer had a prior interest in a portion of a property and now acquires an additional interest in the same property, the additional interest can be bonus eligible, assuming all other criteria are met. For a step up in basis due to death, where a property is passed on from a decedent to an heir, the property there is specifically excluded from bonus treatment. On March 27th of 2020, the government signed into law the Coronavirus Aid, Relief, and Economic Securities Act, otherwise known as the CARES Act, to provide many Americans and businesses economic assistance and tax relief. Although the CARES Act doesn't directly address bonus depreciation rules, it is legislation worth noting because of its effects on bonus depreciation considerations for taxpayers with qualified improvement property or Section 163J elections. Both QIP and business interest expense limitations are discussed in greater detail later. The CARES Act provides a technical correction for the depreciable tax life of QIP from 39 years to 15 years, and it made that correction retroactive for improvement property placed in service on January 1st of 2018 and thereafter. Prior to the CARES Act, the Tax Cuts and Jobs Act constrained the ability to use net operating losses to lower tax liabilities. The Tax Cuts and Jobs Act restricted the carryback of NOLs generated in tax years after December 31st of 2017, and it limited carry forwards to only 80% of adjusted taxable income. The CARES Act now allows taxpayers with NOLs generated in tax years after December 31st of 17, but before January 1st of 2021, to be carried back to each of the 5 preceding taxable years. Businesses that paid federal income taxes in 2013 to 2017 may be able to claim a tax refund as a result of 2018, 19, or 20 NOLs. And in addition to the 5-year carryback, the CARES Act suspends the 80% limit on carry forwards, allowing NOLs to fully offset taxable income until the end of 2020. So most folks now are starting to deal with the 2020 tax year. This is the last year of that period of the CARES Act that gets the favorable treatment. Taxpayers can get refunds by using a change of accounting method, using Form 3115, to maximize losses in the current tax year and carry back to those years where they had taxable income. Qualified improvement property was introduced to us as part of the PATH Act back in 2015 and was effective in 2016 onward. And so we've had it for a while. As discussed before, several special qualified asset classifications were removed as part of the Tax Cuts and Jobs Act, most notably qualified leasehold improvement property, with the intention that qualified improvement property, or QIP, would replace all these other old classifications. Qualified improvement property are basically improvements made by the taxpayer to the interior of a building after the building was originally placed in service, and it must be made to commercial, non-residential buildings. QIP cannot be an elevator or escalator, an expansion, or components that are structural in nature. The QIP definition has some similarities to leasehold improvement property, but does not have to be completed pursuant to a lease and can be improvements made to a common building area. Also, QIP can be improvements made to a building at any point after it has originally been placed in service. There's no 3-year-old building restriction like there was with leasehold improvement property. Prior to 2018, QIP was recovered over 39 years and was 50% bonus eligible. And there was a brief period in the final quarter of 2017 for which the regulations confirmed that QIP acquired and placed in service after 9/27 and before 1/1 of 18 was eligible for the 100% bonus rate, even though it was recovered over 39 years. But the larger issue was that the TCJA removed QIP from the list of property of a specified type, and then in the haste in which the law was written, failed to add that language clarifying congressional intent for a 15-year recovery. And as such, many taxpayers that completed qualified improvement property projects in 2018 and 19 depreciated their property and filed tax returns treating that QIP as 39-year property with no bonus depreciation. After passing the CARES Act, the recovery period of QIP reduced from 39 to 15 years now makes it eligible for 100% bonus depreciation through 2022, and the change is retroactive all the way back to January 1st of 2018. There are certain types of property that are specifically excluded from bonus applicability. In situations where the taxpayer is required to use the alternative depreciation system, the bonus is not applicable. Examples of this include property that's being used outside the United States, tax-exempt use property, and tax-exempt bond finance property. However, using ADS to determine the adjusted basis of a taxpayer's qualified business investment or the adjusted basis of a taxpayer's tangible assets for allocating business interest expense between expected and non-expected trades or businesses does not cause a taxpayer's tangible property to be ineligible for bonus depreciation. Also excluded is property primarily used in certain regulated public utility trades or businesses. This exclusion, though, only applies to property acquired after 9/27/17 and placed in service in tax years beginning on or after January 1st of 18. An example was added to the 2019 final regs to clarify that 100% bonus rate does not apply to self-constructed property of a regulated public utility if construction began after 9/27/17 and the property is placed in service in a tax year beginning after 2017. Some other property excluded from bonus depreciation is property used in a trade or business that has had floor plan financing indebtedness if the floor plan financing interest related to such indebtedness was taken into account under Section 163J1C. Dealerships are the common example where floor plan financing is used. For those dealerships where the operating entity leases from a related real estate holding company, the real estate company can still take bonus on the real estate. The 2019 proposed regs also provide rules that floor plan interest is not considered taken into account for a tax year if the sum of business interest income for the tax year and 30% of the adjusted taxable income for the tax year equals or exceeds that of the business interest as defined in Code Section 163J5, and this test is made annually. In order to be bonus eligible, the property generally needs to be placed in service after 9/27/17 and before January 1st of 23. When determining the placed in service date, the new regs are generally the same as the former rules that were outlined in Section 168K 1B5. When buildings are newly constructed, we normally look to the certificate of occupancy date to define when the building should be placed in service. For acquired buildings, we look to the ready and available for intended use standard. It's possible to acquire a building that's not ready and available to use. Perhaps the interior is unfinished, or there may be plans to gut and renovate the interior in order to attract new tenants. Once that building is ready and available for use, you can begin recovering the cost of it through those depreciation deductions. Qualified film or television production is treated as placed in service at the time of initial release or broadcast, and a qualified live theatrical production is treated as placed in service at the time of the initial live staged performance. Self-constructed property includes property constructed by the taxpayer for its own use, as well as property constructed on their behalf. The property is not considered acquired until the taxpayer begins manufacturing, construction, or producing the property. There is an optional safe harbor that allows the taxpayer to determine the effective acquisition date as the date when 10% of the total construction cost has been incurred or physical work of a significant nature has begun. If more than 10% of the project was incurred prior to 9/28/17, then the old bonus rules will apply, including the old phase down of the bonus rate, meaning 50% bonus back in 2017, 40% in 2018, 30% in 2019, and 0 in 2020. But good news, the component election was introduced with the proposed regs, which potentially allows the taxpayer to bifurcate the project between portions that were completed before and after 9/27/17. And as our examples show, this can enable the project that doesn't meet the safe harbor test to still qualify for the new bonus treatment for some of those project components. Now let's take a look at bonus depreciation in light of a 1031 exchange. There's been a lot of discussion in our industry about the impact on 1031 exchanges. Based on our understanding of the Tax Cuts and Jobs Act and proposed regs, cost segregation should still be beneficial on both sides of the transaction. There's several reasons to support this. First of all, committee reports suggest there's no intent to change the nature of 1031 transactions for real estate. Second, personal property from cost segregation is considered real property under state law. And third, matching of 1245 property is still required in order to avoid recapture. With respect to bonus depreciation, the bonus would only apply to the excess basis in the replacement property. It would not apply to any carryover basis in the property. I should point out here that the IRS published proposed regulations in June of 2020 that took a much more restrictive viewpoint of what would be considered personal property within a real estate transaction. Many taxpayers, tax preparers, and professional organizations provided comments as to why these proposed regs were a really bad idea. The professional organization I mentioned earlier, American Society of Cost Segregation Professionals, was one of those that submitted a write-up on that. Our firm, KBKG, submitted its comments. And perhaps surprisingly, ultimately, the final regs were released in November, and the IRS did a complete 180 on this. And they took to heart all this advice given from industry and completely backed away from the suggestion that there needed to be a special definition given at a federal level for real versus personal property. So, for those who don't realize it, there's actually 100 years of 1031 exchanges out there this year. They've been around that long. And over those years, it's kind of been common understanding that you look to state law for determining what's considered part of the real property that can be exchanged. This all came to a head when the Tax Cuts and Jobs Act changed 1031 exchanges so that they can no longer exchange personal property. The intent was not to affect real estate, but in a cost seg study, we carve out tangible personal property like we've been talking about, but those things we're calling personal property in a cost segregation study in an exchange context are still considered part of the real estate. So everything is still good. You can do a cost segregation study on both sides of the exchanges potentially. It just needs to be thought through carefully. Section 179 allows businesses to deduct the cost of purchasing qualifying equipment and software. For 2020, the deduction limit was increased to $1,040,000, and the 2020 spending cap is set at $2,590,000. So that means there's a dollar for dollar reduction in the $1,040,000 deduction limit for every dollar that's spent in excess of $2,590,000. So a taxpayer who spends $3,630,000 on 179 eligible property would effectively eliminate their capacity to use the 179 expense. The Tax Cuts and Jobs Act permits 179 expensing for roofs, HVAC, fire protection and alarm systems, and security systems. This is only applicable now to commercial buildings, not for residential, and it's limited to improvements made after the building was first placed in service. But generally, the rules in 179D5 will also prevent most non-corporate real estate investors from taking advantage of this special 179 expensing treatment. Here's an example that we have. Suppose your client purchased an existing 10-year-old building in 2020 for $4 million. And before placing in service, they put in a new roof, HVAC, fire protection, and security system for $500,000. All of that would be 179 eligible. Now, you might be thinking, how could that be true since the improvements were done before the taxpayer placed the building in service? The key here is the building was originally placed in service 10 years ago by some other taxpayer, So the building was actually first placed in service long ago. That requirement was met, and so it's not an issue. 179 expensing now includes personal property used for furnishing lodging, such as furniture and appliances in hotels, apartment buildings, and student housing. Something to consider is that there's no real benefit to taking the 179 expense on tangible personal property that's already eligible for 100% bonus depreciation. Taxpayers should consider instead utilizing 179 expensing on items not otherwise eligible for bonus depreciation, like roofs and HVAC equipment. Do note that taking the 179 expense does make them subject to recapture. There's a new revenue procedure, 2020-25, that came out that allows you to use a 3115 to change your incorrect qualified improvement property from 39-year to 15 years. We talked about that earlier, how that was fixed with the CARES Act. For a limited time, you can use change number 245 to change or revoke elections, and this includes ADS, electing in and out of bonus, and electing 50% versus 100% bonus on assets acquired in the 27 tax year. All these changes can be made on 13115. For returns put on extension, you can file a superseded return with Form 3115 as long as it's submitted by the extended due date. A sample Form 3115 template can be downloaded right here on our KBKG resources page. Now let's take a look at the passive taxpayer and talk about the self-rental rule and the grouping election. Many taxpayers have an operating business entity that obtains a property and then rents it to themselves. And the self-rental rule generally does not allow the losses from a real estate company to offset the income from your operating entity. In my example here, our retail business is making $100,000 of income, and the real estate entity has a $100,000 loss because we did a cost segregation study. Since the self-rental rule says we can't use the real estate losses against the S-Corp income from the retail business, we end up having to pay about $40,000 in tax. This has to do with passive activity loss rules. The grouping election should be considered if the real estate is actually being used by the operating entity and the same owner owns 100% of both entities. In this case, this allows you to group the activities and use the losses from one business to offset the income in the other business. And under this scenario, that same owner with $100,000 of income in the retail business and $100,000 of losses from the commercial rental property ends up paying zero tax. The taxpayer can only make the election to aggregate the activities when the entities equally qualify for that grouping. The election requires the attachment of a formal statement to the return. Cost segregation can actually be a useful tool in estate planning. This may be a surprise to a lot of you. For this strategy, I'm going to start with some basic rules related to estates that involve real estate. First of all, when a building owner dies, the property is inherited, and when it's appreciated, any gains that were built up during the decedent's life are simply forgiven. The beneficiary receives a step-up, which means the property's tax basis gets reset to the fair market value on the date of death, and the beneficiary starts depreciation all over again. This provides an opportunity here to apply a cost segregation study on the decedent's pre-stepped-up basis, and in that case, it creates a permanent tax deduction. To illustrate, let's look at the building here purchased by the decedent 6 years ago when the death happens in August of the current tax year. Since the original investment of $1 million is considered residential rental property, it's depreciated over a long life of 27.5 years. So by the time of death, the decedent will have roughly $728,000 of depreciation that he never got to deduct. The decedent will still need to have a final tax return prepared for the final year, the year of death. Now, supposing the decedent had sold the property for $2 million before he died, in that case, there would have been a taxable gain of $1.27 million. However, it didn't happen that way because in our situation, the current estate tax rules forgive any taxable gains built up by the decedent. The beneficiary gets a full step up to fair market value of the property on the date of death. So in this case, $2 million. And the beneficiary now records the $2 million basis on their tax return going forward. Now, most CPAs already know that doing a good cost segregation study on that $2 million stepped up basis is a good idea. But what many tax preparers overlook is the time-sensitive opportunity to apply that cost segregation study to the pre-stepped up basis. This allows the decedent to claim even more depreciation deductions before the death, lowering that building's tax basis even further and creating an even higher step up to the fair market value. The idea here is to take as much depreciation before the death as possible, since the heir is going to get the same step up to fair market value regardless of the decedent's basis. This strategy yields the greatest benefits for the estate because these deductions would otherwise be lost forever if they're not taken on the decedent's last tax return. When we conduct a cost segregation study on the building as of its early purchase date, we identify items in the building purchase price that should have been depreciated with shorter recovery periods. In our case study, a cost segregation study identified $200,000 of things like cabinets, ceiling fans, and appliance-related electrical that all can be recategorized as 5-year property. It also identified another $100,000 of things like parking lots, landscaping, and fencing that can be recategorized as 15-year recovery property. And since the decedent should have written off these items much quicker than the 27.5-year life that he used, the IRS allows him to claim any missed deductions on the final tax return using Form 3115. In our case study, when the decedent's final return is filed along with Form 3115, they claim the missed depreciation deductions of approximately $174,000. And as discussed, this lowers the decedent's tax basis, but that's okay since the heir gets a step up to fair market value regardless of the decedent's basis. Because these deductions would have been lost forever, the result is a permanent tax savings just over $68,000. Now, I mentioned that this needs to be done on the decedent's final tax return. That's because when a building is acquired in a tax year prior to death, in order to apply a cost segregation study, a 3115 is required and generally cannot be filed on an amended return. From the heir's perspective, they now get to step up the basis to the current fair market value and begin that depreciation all over again. And since they've already had a retroactive cost seg study done on the property, they can have that study tweaked and updated to reflect the new fair market value step-up basis at a very minimal cost. And this allows the heirs then to maximize their future deductions going forward on the new basis. Here's a snipped image for you of what we call our Qualified Improvement Quick Reference Chart. It's available at our website at the kbkg.com/resources. Many of our CPA clients love this chart and keep it handy, pass it out to their staff and their clients. I encourage you to take a good look at it. It's our most popular download of anything we have out there. How long does it take to complete a study? Typically between 30 to 60 days from the time all information is received. It's a good idea to plan ahead, though, for those tax deadlines. If you need it for March 15th, we recommend engaging early as possible. We're overwhelmed already for March 15th work that we're doing. How much does it typically cost? Projects probably fall between $6,000 and $16,000 on average. It generally depends on the size and type of building. Have there been renovation costs on top of the building acquisition? Do renovations span multiple years? For smaller residential properties, there's ways to address those inexpensively using that software tool I mentioned. How do you pick a provider? Well, I definitely recommend you find one that has a certified cost segregation professional working for them that is going to take ownership of that process and review the work product and sign off on its quality. You should evaluate the resumes and bios of the people that are actually going to do the work, not just the people who are selling it. Find out how long the provider's been in business and how many studies they've done. Consider their experience with the tangible property regs. Will they be prepared to address those retirements and dispositions, repairs versus capital expenditures? Consider their experience with 179D and 45L green building projects. Consider who you want defending you if the study goes to audit. Will they be around? Consider the resources available to the provider. Low-cost or small providers sometimes just don't have the resources to stay on top of all the issues that come up. As we kind of bring it to a close, I threw in some other related slides that are tangent, but related to recent legislation. The 45L residential energy tax credits is a $2,000 credit per dwelling unit, and part of the extenders package from back in December last year, or in 2019, extended 45L out, and now it's been extended all the way through 2021. So that's good news. It's a good credit, a lot of a very popular one that clients like to take advantage of. The 179D commercial energy deduction is not a credit, but a deduction for energy efficient buildings, commercial buildings, and this was made permanent in the past year, so no more extending it from year to year. That's good news for a lot of taxpayers. It's potentially up to $1.80 a square foot, depending on how many systems you have in the building that qualify for this deduction. A unique feature of this is that architects and designers of energy efficient buildings can take advantage of this when they're designing government buildings that are energy efficient. The government is not a taxpayer, so the deduction was written in such a way that the designer who does not have basis in the building gets to take advantage of that up to $1.80 a square foot if they've designed it in a way that it would otherwise qualify for the 179D deduction. The research and development tax credit is another one that's a permanent credit and one that we are involved with at KBKG. Very popular one to consider. And then transfer pricing. It's a service line that can help with the NOLs we talked about when we mentioned the CARES Act, allowing you to carry back those deductions 5 years. If you're looking for ways to boost those deductions and you have a multinational company, the potential need to evaluate transfer pricing between countries is another way that you might end up adding to some of those losses that can get pushed back into years where the tax rates were higher. And finally, the IC-DISC, the Internet Interest Charged Domestic International Sales Corporation, offers federal income tax savings for making or distributing U.S. products for export. So it's kind of a small niche kind of a product where it was originally created by Congress to promote export sales by allowing companies to defer income with interest charged on the deferred tax. And now the IC-DISC provides an opportunity for permanent tax savings for producers and distributors of U.S.-made products abroad. And last but not least is a fixed asset review. Sometimes, because of the tangible property regs, you can discover a lot of opportunities by doing a fixed asset review. That review might discover missed bonus opportunities. It could discover opportunities for retirements, dispositions, miniature cost seg studies, retroactive major cost seg studies from the past. But fixed assets can be a mess, and so taking a good scrub of those from the past is a way to fix a lot of that, get rid of those ghost assets. And with that, we're going to cruise in for our final landing here. I want to thank you for joining us today. My contact information is provided on this slide. If you'd like to expand your professional network by connecting with me on LinkedIn, I certainly invite you to do so. And if you have questions about the material that we've covered or would like to discuss an opportunity, please call us. We do offer those other webinars that you might be interested in, a variety of topics. You can check those out at kbkg.com/webinars.